Creamer Media's Resources Watch, a weekly video roundup of the events and people making and shaping the news in the mining industry. This week, Southern Africa's green hydrogen buy-in exceeding expectations, new venture capital incubation fund targeting small-scale mining space, and environmental underinvestment comes back to bite. Southern Africa's buy-in into the green hydrogen economy concept is exceeding expectations.
We've got 12 countries that we are actively working on in terms of the development of the hydrogen atlas. And we have already established national teams in all these countries. And these national teams, as we speak, they're very active on the ground. On daily basis, we are getting information, feedback with meetings that they are holding with national stakeholders. And it's to our surprise, actually, is that the buy-in that we got is even beyond our expectation. It seems like in some countries, they are telling us that we are far behind in terms of taking action because as they are reading and getting engaged, they're inundated also with private sector players that are coming in, some of them wanting to sign MOUs, some of them requesting some guidance on how they can start developing this sector. So I think, yes, we have come at the right moment. And the buy-in from stakeholders, especially the government, is so huge.
Venture capital incubation fund initiator Pearl Grey Equity Partners is targeting South Africa's small-scale gold mining space.
What we're essentially doing is bringing a venture capital sort of concept into the mining space. We had a little bit of a look at the small-scale mining space, and it looks a little bit distressed, in my opinion, with regards to legislation, with regards to a lack of knowledge of really how to access capital, of how to access proper sort of individuals who will provide operational skills. And that's essentially what we're doing. We're going to be skin in the game as well. So what we're essentially doing is working with mining companies, small-scale mining companies, using a bit of our money and being nimble in a way where we are going to source additional funds as well. We're a family investment office, so we're not a big investment company. So using the word nimble again is really just a way for us to enter the mining space, which is profitable. And I mean, this is Africa. It's always been a good industry, and I believe there's a lot of potential.
If you underinvest in environmental impact, it will come back to bite you at some time in the future, just like cutting back on development used to do in the old days.
When you have the urgent need to cut costs, clearly the things that you cut generally are things which are not really good for you in the long term. I mean, in the old days, the easiest way of actually improving your C1 cash costs is to cut back on development, because you don't actually see the negative aspects of cutting back on development until maybe a year or so later, but you can have an immediate impact on costs. If you underinvest in environmental impact and safety and stuff like that, again, it comes back to bite you at some time in the future. So invariably, those things require investment. But I've generally found that improvements in productivity and output go hand in hand with investments in these areas. So I don't think that because you have the appropriate amount of energy and investment in things like ESG, and ensuring that your maintenance regimes are right and your development is right, actually is a increase in costs with no benefit. I actually think that it goes hand in hand with improvements in productivity, and I think you find you get those back. So I don't actually think ultimately there's a trade-off. I think you need to make the case for why you do it, but I think you gain almost immediate benefit aside from the direct aspects of ensuring you're not creating the risk by underinvesting in those areas.
For mining news as it breaks, stay logged on to miningweekly.com and register for our free daily newsletter.